Stop what you're doing right now because gold just made a move that most people are going to explain completely wrong. And if you hold even 1 ounce of gold, 1 share of a mining stock, or any silver position at all, you need to understand what actually happened before you make your next decision. On Friday, gold surged almost 2%. Silver followed with a similar move. Haven assets came roaring back after getting beaten down earlier in the week, and the headlines are already flooding in with the same tired explanations. Geopolitical tensions, safe haven demand, flight to quality. You've heard it all before. But here's the problem. Those explanations are only half the story. And if you only understand half the story, you're going to make decisions based on incomplete information. And incomplete information in markets like this doesn't just cost you profits, it costs you your position entirely. So, in this video, I'm going to walk you through what's really happening beneath the surface, why gold and silver moved the way they did, what central banks are signaling that mainstream media isn't covering properly, why Treasury yields are creating a short-term headwind but a long-term tailwind, why institutional money still hasn't shown up in gold and when that's likely to change, what the Iran conflict means for silver specifically, and why Bitcoin might actually be delaying the biggest gold rally we've seen in decades. By the end of this video, you'll understand the mechanics driving this market better than 95% of investors. And I'll give you the one framework that separates people who profit from precious metals from people who get shaken out right before the biggest moves. But first, I need 30 seconds of your time for something important. If you get value from this channel, if the OG John Ag helps you make sense of markets that feel increasingly chaotic, then hit that subscribe button right now. I'm building something here, a community of investors who want real analysis, not hype, not clickbait, not recycled headlines, actual thinking about what's happening and why it matters. And make sure you hit the notification bell so YouTube actually shows you my videos when they drop, because by the time the algorithm recommends the next video, the move has often already happened. You want to be ahead, not behind. Now let's get into the substance. Gold closed Friday around $4,190 per troy ounce. That's a 1.8% gain on the futures, and spot gold actually did even better, up nearly 3% to $4,494. Silver pushed up to $69.20. These are significant moves, especially after the brutal action we saw earlier in the week. But here's what I need you to understand. This wasn't just about Iran. This wasn't just about safe haven buying. Something more structural is happening, and most analysts are missing it entirely. Let me break this down, layer by layer. First, the obvious story. Yes, geopolitical tensions are elevated. The conflict between the United States and Iran continues to escalate. President Trump and Iranian authorities remain at an impasse. There's genuine uncertainty about how this plays out. And historically, when uncertainty rises, investors move toward assets that have no counterparty risk. Gold is the ultimate expression of that. It's not someone else's liability. It just is. So part of Friday's move was absolutely classic safe haven behavior. Stocks sold off, US indices lost ground, and money rotated into precious metals. That's the textbook explanation. But here's the twist that almost nobody is talking about. The same conflict that's driving safe haven buying is also driving something else entirely. It's driving expectations for interest rate hikes, and that creates a fascinating contradiction in the market that most investors don't understand. Think about it. Before this conflict escalated, markets were pricing in rate cuts. Remember, just a few months ago, everyone was talking about when the Fed would start cutting, how many cuts we'd get this year, what that would mean for asset prices. That was the consensus. Now that consensus has completely flipped. Investors are now anticipating rate hikes to curb inflation rather than rate cuts. The conflict is disrupting supply chains. Energy prices are volatile. Inflation expectations are rising and central banks are being forced to respond. So you have this incredible situation where the same event, the Iran conflict, is simultaneously bullish for gold through the safe haven channel and bearish for gold through the opportunity cost channel. Higher rates mean higher treasury yields. Higher treasury yields mean gold, which pays no income, becomes relatively less attractive compared to bonds that are now paying more. This is why gold has been choppy. This is why you've seen violent swings in both directions. The market is literally fighting with itself, trying to figure out which force is stronger, and most investors don't even realize there are two opposing forces at play. Let me pause here and ask you something. Where are you watching from right now? Drop your country or city in the comments. I'm genuinely curious about where the OG John Ag community is spread around the world. And while you're down there, tell me, are you primarily holding physical metal, or are you using paper exposure like ETFs and futures? I want to understand how you're positioned because it helps me create content that's actually relevant to your situation. Now let's go deeper on the Treasury yield situation because this is where people get confused. Since the conflict began, 10-year Treasury yields have risen 30 to 40 basis points. That might not sound like much, but in the bond market, that's a significant move. If you were holding a 10-year note in January and you held it through today, you've lost somewhere between 3 and 4% on those bonds in terms of value. Think about that. Treasuries are supposed to be the safe asset, they're supposed to be stable, and holders just lost 3 to 4% in a matter of weeks. That's not stable. That's volatility that rivals equity markets. Now, what does this mean for gold? In the short term, it creates a headwind. When yields rise, the opportunity cost of holding gold rises too. Gold doesn't pay interest, a treasury bond does. So when bond yields go up, some marginal buyers who were considering gold say, you know what, I'll just buy the bond instead and collect that yield. This is real. This is happening. And it's one reason why gold has struggled to make consistent upside progress, even as inflation fears accelerate. But here's what the short-term thinkers are missing entirely. The reason yields are rising is because the fiscal situation is deteriorating. The government is facing massive deficits. The debt is ballooning. And in every conceivable scenario, the government is going to have to print more money. There's no realistic path to fiscal sustainability that doesn't involve monetization of debt at some level. And what happens when governments print money? Currency gets debased. Purchasing power erodes. And gold, which can't be printed, becomes more valuable relative to the currency that can be. So yes, rising yields are a short-term headwind for gold, but the reasons why yields are rising are profoundly bullish for gold over the medium and long term. The people selling gold because yields went up are going to be the same people chasing gold higher in 12 months when they realize the underlying situation got worse, not better. This is the mistake I see constantly. People react to the immediate signal without understanding the underlying cause. They see yields up, gold down, and they think that's the end of the story. It's not. It's just the beginning of a much bigger story. Now let's talk about something that genuinely fascinates me, and it should fascinate you too if you're serious about understanding where gold goes from here. Institutional investors still haven't shown up in gold. Not really, not in any meaningful way. And I find this absolutely remarkable given what gold has done over the past several years. Gold has outperformed virtually every other major asset class. It's been one of the best performing assets, period. And yet when you look at institutional portfolios, the allocation to gold is minimal, sometimes zero. Why? According to some of the smartest people in the precious metals space, there are two main reasons. The first is a lack of expertise. Most institutions got out of commodities and precious metals around 2015 when the sector had its big correction. When they exited, they also lost their institutional knowledge. The analysts who understood these markets left. The expertise evaporated, and it was never rebuilt. So today you have large institutions, banks, money managers, endowments that literally don't have anyone internally who can make an informed call on gold. They don't have the personnel, they don't have the frameworks, they don't have the institutional muscle memory. And from a career perspective, it's often easier for a portfolio manager to do nothing than to do something. If you recommend gold and it goes down, you look like an idiot for buying a pet rock. If you don't recommend gold and it goes up, well, everyone else missed it too. So there's safety in the crowd. The incentive structure discourages independent thinking. The second reason institutions haven't moved into gold is even simpler. They haven't had to. Equities have been working. The S&P 500 has been delivering returns. Why would a portfolio manager go through the trouble of learning a new asset class, building new models, defending a controversial position to their investment committee when they can just keep doing what they've been doing and still hit their targets? That's the reality. Institutions are creatures of inertia. They continue doing what's been working until it stops working. They don't anticipate. They react. So, what does this mean for gold? It means the biggest wave of institutional buying is still ahead of us. It hasn't happened yet. And when it does happen, it won't be gradual. It will be a stampede. Because here's how institutional behavior works. They ignore an asset class for years. Then something forces them to pay attention. Maybe equities crash, maybe inflation becomes undeniable, maybe their peers start allocating and they don't want to be left behind. Whatever the trigger, once it happens, they all move at once. And when institutions move into gold, they move with size. We're not talking about retail investors buying a few ounces. We're talking about pension funds, sovereign wealth funds, endowments moving billions of dollars into a market that is not that big relative to global capital. What happens when massive demand meets limited supply in a small market? Price doesn't crawl, it lunges. This is why I believe the real gold move, the move that makes the last few years look like a warm-up, is still in front of us. The central banks started accumulating a few years ago. Individual investors started coming in around mid-2024. Some institutions dipped their toes through ETFs. But the big institutional wave is still loading, still waiting, still to come. And when it arrives, you don't want to be scrambling to get positioned. You want to already be there. Let me share a story that perfectly illustrates the current institutional mindset. There's a very large family office in Europe. Old money, generational wealth, the kind of institution where protecting capital should be the absolute top priority. Someone asked them recently about their gold allocation. Their answer, absolutely zero. No gold, no commodities, nothing. But here's the kicker. That same family office had just allocated $200 or $300 million to Bitcoin. Let that sink in for a moment. An institution with a centuries-long time horizon, whose primary mandate is wealth preservation, chose to invest hundreds of millions in an asset that didn't exist 15 years ago and experiences 50% drawdowns regularly, while simultaneously holding zero gold. Why? Because the chief investment officer doesn't like commodities. That's the reason. Not analysis, not valuation, not risk assessment, personal preference. This tells you everything you need to know about where we are in this cycle. The institutions that should be in gold aren't. The institutions that are supposed to be sophisticated are making emotional decisions, and the asset that has preserved wealth for 5,000 years is being ignored in favor of assets that have existed for a decade. This won't last forever. Eventually, reality forces a reassessment. And when these family offices, these pension funds, these endowments finally turn their attention to gold, they're going to realize they're late. And being late means paying higher prices. By the way, I'm curious, how many of you have been watching gold for a while and noticed this institutional absence? Were you aware that most large institutions have basically zero gold exposure? Drop a comment and let me know, and tell me what you think will be the trigger that finally forces them to pay attention. Now let's shift to silver, because silver has its own story, and it's more complicated than gold's. Silver has a dual nature that makes it fascinating, but also harder to analyze. It's both a monetary metal and an industrial metal. About half of silver demand comes from industrial applications: electronics, solar panels, medical devices, the stuff that makes modern civilization function. This industrial component creates a problem in the current environment. When you have geopolitical conflict like what's happening with Iran, you have to worry about economic growth. Wars disrupt supply chains. Wars create uncertainty. Uncertainty makes businesses delay investments. Consumers become cautious. Economic activity slows. And when economic activity slows, industrial demand for silver softens. People buy fewer electronics, solar installations get delayed, manufacturing contracts. So silver faces this headwind that gold doesn't face. Gold is pure monetary metal. Nobody uses gold in factories, but silver is tied to the real economy in a way that creates vulnerability during periods of economic stress. Here's what's interesting, though. Even with this industrial uncertainty, silver is still expected to be in deficit this year. That's 6 consecutive years of deficits, demand exceeding supply for 6 years running. The structural backdrop remains tight, and on the investment demand side, silver still benefits from the same forces driving gold. Inflation concerns, currency debasement, the desire for tangible assets. Silver is monetary metal too, even if it doesn't get the same respect as gold. But here's the honest assessment. In the short term, the weight of potentially lower industrial demand plus rising yields probably overwhelms the safe haven appeal. Silver is facing more headwinds than gold right now. That doesn't mean silver is a bad investment. It means you need to understand what you own and why. If you're holding silver as long-term monetary insurance, the short-term industrial fluctuations matter less. If you're trading silver for quick gains, you need to respect that it might underperform gold during this particular phase. And historically, silver tends to follow gold's lead. When gold starts trending higher decisively, silver typically follows and often catches up with a vengeance. Silver has more beta. It moves faster in both directions. So if gold breaks out, silver will probably outperform, but silver rarely leads the charge. It waits for gold to go first. This brings me to something that's been frustrating silver and gold investors for months: the mining stocks. If metals are ripping, why aren't mining stocks flying? I've seen this question constantly. People own gold miners, they watch gold go up, they expect their miners to go up more, and then the opposite happens. Miners lag, miners drop, miners refuse to cooperate. Earlier this week, Antofagasta, the copper and gold mining company, fell 24% since the conflict outbreak. 24% while gold was doing nothing particularly bad. How does that make sense? It makes sense when you understand that miners are businesses, not bars of metal. Miners have costs. They have employees. They have equipment. They have energy bills. They have political risk in the jurisdictions where they operate. They have management teams that can make good or bad decisions. They're complex operating businesses with 100 ways to disappoint, even when the underlying commodity does well. And critically, miners trade in the equity ecosystem. When there's a broad risk-off move and people sell stocks, miners get sold as stocks. The fact that they produce gold doesn't insulate them from equity market dynamics. This is why minor underperformance doesn't automatically mean the metal move is fake. Sometimes it just means investors prefer clean exposure. They want the metal itself, not the operational complexity of a mining company. And here's another factor nobody talks about enough: energy costs. Miners need enormous amounts of energy to dig stuff out of the ground. When energy costs rise, miner margins get squeezed even if metal prices rise. So a rising oil environment, which we have right now given Middle East tensions, can actually hurt miners even as gold goes up. The metal price rises, but their costs rise too. And sometimes costs rise faster. This is why miners don't behave like automatic leverage on the metal. Sometimes they amplify gains, sometimes they disappoint completely. You can be right on gold direction and still lose money on miners if you don't understand the other variables. So what do? You decide what you're trying to accomplish. If you want pure exposure to gold price movements, own gold. Physical gold, gold ETFs, allocated gold products. If you want leverage and you're willing to accept operational risk, own miners, but understand what you own. Don't expect miners to track gold perfectly because they never have and never will. Now, I want to address the psychological challenge that trips up most precious metals investors. This market is designed to make you uncomfortable. The volatility, the sudden reversals, the conflicting signals, all of it serves a purpose. Markets move to levels where they can find buyers and sellers. And in precious metals specifically, that often means creating maximum emotional pain before the next major move. Think about what we've seen lately. Gold drops on Treasury yield concerns, then it rips on safe haven buying, then it consolidates, then it drops again, then it rips again. Every few days, the narrative changes. Every few days, your conviction gets tested. This is not an accident. This is how markets work. The volatility shakes out weak hands. The conflicting narratives create confusion. The rapid reversals make people doubt their analysis. And then after everyone who can be shaken out has been shaken out, the real move begins. So if you're sitting there feeling uncertain, feeling like you don't know what to do, feeling like maybe you should just sell and come back when things calm down, understand that this feeling is part of the process. You're supposed to feel this way. The market is supposed to create this emotion. Your job is to not react to the emotion. Your job is to have a plan and stick to it. What's your process? That's the question that matters. Not what will gold do tomorrow, not whether silver breaks out this week. Your process. Is the long-term trend still intact? Yes, higher highs and higher lows over the multi-year time frame. Are pullbacks being bought? Yes, Friday's action showed that. Is the fundamental backdrop supportive? Yes. Deficits, currency debasement, institutional underallocation. Is your position sized appropriately for the volatility? That's on you to answer honestly. If you have a process and you follow it, you can survive the emotional warfare. If you don't have a process and you're making decisions based on how you feel in the moment, you're going to get destroyed. Not might, will. Here's the framework that separates winners from losers in precious metals. You don't get paid for certainty. You get paid for process. Certainty doesn't exist. Nobody knows if gold hits $5,000 next month or pulls back to $4,000 first. Nobody knows if silver breaks $100 this year or chops sideways for 6 more months. Anyone who tells you they know with certainty is either lying to you or lying to themselves. But process you can control. Position sizing that lets you hold through volatility without panicking. Entry strategies that don't chase breakouts emotionally. Exit plans that lock in gains without trying to pick exact tops. Risk management that keeps you in the game even when you're wrong. That's what wins, not predictions. Process. Now, before I let you go, I want you to think about something. The next few months in precious metals are going to be chaotic. The Iran conflict is ongoing. Treasury yields are volatile. Institutional positioning is about to shift. Economic uncertainty is elevated. All the ingredients are in place for significant moves in both directions. Some people are going to make a lot of money. Some people are going to lose everything they put in. The difference won't be who had better information. The difference will be who had better process. So I'm going to ask you directly, what's your plan? Do you have one? If gold drops 15% tomorrow, do you know what you're going to do? If gold rips through $4,500, do you know what you're going to do? If silver suddenly spikes to $80, are you adding, holding, or selling? You need to know these answers before the market asks the question, because when the market asks, you'll have about 30 seconds to decide. And if you haven't thought it through in advance, you'll make an emotional decision that you'll regret. Drop your plan in the comments. Seriously, write it out. I'll read through them, and in a future video, I'll address some of the most common strategies and potential pitfalls I see. Also, I want to hear from different perspectives. If you've been investing in precious metals for over 5 years, comment veteran and tell me the most important lesson you've learned. If you're new to this space in the last year, comment newcomer and tell me what's been most confusing. I'll use this to shape upcoming content. Now here's what I want you to do next. Subscribe to the OG John Ag if you haven't already. I'm going to be covering the institutional flow into gold extensively over the coming months because I believe that's the story that matters most for long-term investors. You don't want to miss those videos. Hit the notification bell so YouTube actually puts my videos in front of you when they go live, because the algorithm isn't always your friend. And come back for the next video, because here's what I'm planning. I'm going to do a deep dive specifically on the institutional allocation question. How much money is actually on the sidelines? What would it look like if even 5% of institutional capital moved into gold? What price levels does that imply? I'll run the numbers and show you exactly why I think the biggest move is still ahead. Now here's the final thought I'll leave you with. Gold isn't expensive. Currency is cheap. The measuring stick didn't change. Your ruler got shorter. When it takes more dollars to buy an ounce of gold, that's not gold becoming more valuable in some absolute sense. That's dollars becoming less valuable. Gold is just the mirror that shows you what's happening to your purchasing power. And right now, that mirror is telling you something important. Every major government on earth is debasing their currency. Every central bank is facing impossible choices. Every fiscal authority is spending more than they take in. The trajectory is clear. The destination is clear. The only question is timing. So when you see gold volatility, when you see silver swings, when you see miners getting crushed, zoom out. Remember what you own and why you own it. Remember that short-term noise is exactly that noise. Remember that the people selling today will probably be buying at higher prices tomorrow. And remember that in precious metals, the biggest gains go to people who can endure the biggest discomfort. That's the price of admission. That's the tax you pay for being right before the crowd. The question is, can you pay it? I believe you can. That's why you're here. That's why you watch the OG John Ag. You're not looking for easy answers. You're looking for real understanding. And real understanding is what lets you hold when everyone else is folding. So hold your ground, trust your process, subscribe to the channel, and I'll see you in the next video where we go even deeper.